So next section, we have conduct of an audit of financial statements. So in this part, we will discuss the basic concepts underlying an audit of financial statements. So the different concepts that underlie the financial statement audits are as follows. So number one, we have the ethical requirements. So two, the concept of professional skepticism and professional judgment. Next, we have materiality, the evidence and management assertions. We also have the concept of audit risk. And finally, the inherent limitations. So many of these concepts were already covered or introduced in one of our previous discussions. But anyway, we'll still emphasize or highlight them in our discussion in this video lecture. So first, we have ethical requirements. The auditor is subject to relevant ethical requirements, including those pertaining to independence relating to financial statement audit engagements. Now, the relevant ethical requirements on our part as auditor ordinarily comprise Part A and Part B of the Code of Ethics for Professional Accountants in the Philippines, or also known as the Code of Ethics. So this Part A and Part B are the part of our Code of Ethics that are relevant in public practice. So that is why in an audit of financial statements, so together with any national requirement, for example, those provided by our Board of Accountancy or BOA or SEC, so we have to consider the pronouns or the concepts here in our Code of Ethics in performing our audit engagement. So in Part A of the Code or Part A of the Code of Ethics, it establishes the fundamental principles of professional ethics relevant to us auditor when we conduct audit of financial statements, and it also provides a conceptual framework for applying those principles. So meaning to say, Part A of the Code of Ethics comprise of the fundamental principles and a conceptual framework in applying those fundamental principles. And we have 5 fundamental principles. First, integrity. Next is objectivity. Next is professional competence and due care. Next is confidentiality. And last, we have professional behavior. So we'll discuss these fundamental principles on a more deeper manner when we go to our discussion on Code of Ethics. So we have a separate discussion on Code of Ethics for Professional Accountants in the Philippines. And the next, we have Part B of the Code. So yung Part B is the application of this framework in specific situations, particularly in public practice. Now, another important ethical requirement in the conduct of audit of financial statements is what we call the independence. Because in case of audit engagement, it is in the public interest and therefore required by our Code of Ethics that the auditor be independent of the entity that is subject to audit. Now, the Code of Ethics describes independence as comprising of both, number 1, independence of mind, and number 2, independence in appearance. The auditor's independence from the entity safeguards the auditor's ability to form an audit opinion without being affected by influences that might compromise the auditor's opinion. Independence also enhances the auditor's ability to act with integrity, to be objective, and to maintain an attitude of professional skepticism. So when you say independence of mind, so that means that the auditor knows for himself that he is not in any way connected with the entity. So meaning to say, the auditor does not have any financial interest or other interest with the entity. So like for example, investment or loan or any other interest. Okay? Or the auditor also knows for himself that he or she is not employed by the entity he or she is auditing. So that is considered independence of mind. When we say independence in appearance, so it means even if the auditor is not connected to the entity by way of financial or other interest or even employment, the auditor is still distances himself or herself in such a way that third party will not be able to judge, no, or tell that the auditor is not independent from the entity. So even if in fact the auditor has no connection at all in the entity. So because let's say the auditor has no financial or other interest, or the auditor is not employed, and the auditor rather is not employed by the entity, but the auditor always shows to the public, for example, or to the employees of the entity, that the auditor is unusually close, no, with let's say the management or the officers of the entity, in such a way that the third party we cannot tell whether the auditor is not really independent of the entity, then that will be a violation of independence in appearance. So it's not enough that you do not have financial interest or other interest and you are not employed by the entity. It's also important to show it to other people that you are not connected with the entity. So you will only interact professionally with your client, with the officers of your client, to show to the third party, to the employees, to the public, that you are really independent from the entity. And finally, we also have what we call the quality control standards. So these quality control standards, for example, the Philippine Standards on Quality Control 1 or PSQC 1, and the Philippine Standards on Auditing or PSA 220. So these quality control standards set out the responsibilities of the firm, so meaning the auditing or the accounting firm, for establishing policies and procedures designed to provide the firm or the accounting or auditing firm with reasonable assurance that the firm and its personnel comply with the relevant requirements, so including those pertaining to independence. And also, aside from compliance, that the firm, the auditing firm, are able to issue the report that is appropriate under the circumstances. So therefore, the objective of the quality control standards is to provide reasonable assurance that the firm, including the partner and its personnel, are compliant with the applicable standards, laws, and regulation, and that also the firm issues the report that is appropriate under the circumstances. Next, we have conduct of an audit in accordance with the PSAs or Philippine Standards on Auditing. The requirement is that the auditor shall comply with all PSAs that are relevant to the audit. So it's not enough that you comply with majority of the PSAs or some of the PSAs. It should be all PSAs relevant to the audit. And take note that a PSA is relevant to the audit when the PSA is, number one, in effect, and number two, the circumstances addressed by such PSA exist. So for example, if a certain PSA requires an auditor to perform this procedure on inventory and your client has inventory, then therefore you have to comply with that PSA. That PSA is relevant to the audit because it is in effect and the circumstances addressed by that PSA exist in your engagement. Now, take note also that in exceptionally rare circumstances, the auditor may judge it necessary to depart from a requirement of PSA which does not meet the objective of the audit and perform alternative procedures, but is expected to be rare. So meaning if there is a specific situation wherein you cannot address the audit objective when you follow the requirement of the PSA, then you are allowed to depart and perform alternative procedure. Now finally, if compliance with the PSA cannot be achieved, then the auditor should either modify his or her opinion or withdraw or resign from the engagement.